Welcome to this episode of Investment Management Foundation. My name is Gary Quinzel, Vice President of Portfolio Consulting. Today's topic, adding alternatives for portfolio diversification. One of the best ways that you can help optimize a portfolio is by considering adding alternative investments to a traditional portfolio of stocks and bonds. You may be wondering to yourself, what does that mean to optimize the portfolio, and why do risk-adjusted returns even matter? So if we step back in time, back in 1952, an economist by the name of Harry Markowitz wrote a paper called Portfolio Selection that eventually won him a Nobel Prize in economics 4 decades later. The key takeaway from Harry's paper was that a diversified portfolio is far less volatile than the sum of its individual parts. And this evolved into something called modern portfolio theory, which continues to be one of the driving principles behind portfolio construction today. And it really has such an amazing impact on everything we do as investment practitioners. Market portfolio theory allows investors to assemble a portfolio of assets that help maximize the expected return of a portfolio for a given level of risk. And the reason I bring this up is because as investment practitioners, we use modern portfolio theory to establish an efficient frontier, which is basically a curved graph that goes from the lower left to the upper right if we plot different investments on a scale of volatility on the x-axis, the bottom axis, and expected return on the y-axis or the left axis. And we do this in order to optimize the expected return of our portfolios given an investor's level of risk. Okay, so that was a little academic, and let me explain why this matters to investors. Well, normally, most retail investors typically only use stocks and bonds. They invest in what's familiar, and stocks and bonds are the most widely known and widely available instruments that are available to retail clients. But institutions, endowments, foundations, pension funds, etc., figured out a long time ago that adding alternatives to a portfolio that's already diversified in stocks and bonds is a great way to move the expected risk-adjusted return up and to the left, as this graph demonstrates. And when I say up and to the left, what we're essentially meaning is based upon the portfolio's expected volatility, we can actually forecast that over time it should have a higher risk-adjusted return. And now there's many different alternatives to think about. There's everything from private equity, private credit, hedge funds, real assets, and many iterations in between. The key to investing in alternatives is to have a diversified mix of alternatives that help meet your individual objectives and satisfy your individual risk tolerance requirements. As this chart demonstrates, a 60-40 client, for example, can go on to something like 30-40-30 and many, many other iterations. So there's really no one solution that's best fitted for clients. I think the key takeaway here to remember is that portfolios can be optimized in the sense that by adding additional strategies that have low volatility and low correlation to one another, we can actually lower the overall volatility of the portfolio and help increase the odds of having lower vol and higher risk-adjusted returns over the long run. Admittedly, alternatives are not fit for everyone. There's a lot of considerations, such as potentially higher fees and less liquidity and lockup periods over time, and those should be talked about with your financial advisor. But we think that for many clients who are looking to lower their volatility, they should be considered as part of the mix. We hope you found this overview of alternatives helpful, and thank you for listening to this episode of Investment Management Foundation. We hope you tune in for future episodes. Thank you.